Welcome to the deep dive. Today we are really cracking open the rule book on financial statements.
Yeah.
We're looking at measurement within the conceptual framework.
That's right. It sounds technical, maybe, but how we measure things fundamentally shapes the numbers everyone sees.
Absolutely. So our mission today, define those key measurement bases, but also really dig into why the old favorite historical cost, it causes some serious problems, especially when prices are shooting up.
Mm-hmm.
And then we'll look at the alternative that popped up, like CPP and CCA.
And it's critical because, this choice of measurement, it defines the profit reported, the value of assets on the books. It dictates whether you as a user can truly judge how well management's done.
Right.
And if you can make sensible economic decisions based on those reports, it's about the integrity of the whole system, really.
Okay, so let's lay the groundwork. The IASB's conceptual framework talks about 4 main ways to measure things. What are these sort of pillars?
Okay, the 4 big ones. First and most common initially is historical cost. Basically, the actual cash paid, or what you gave up for the item way back when.
Got it. The original price tag.
Exactly. Second, current cost. Now, this is different. It's what you'd have to pay today to replace that same asset, considering its age and condition.
Okay, replacement value now.
Third, fair value. Think market price. What could you get for it if you sold it today in a normal, orderly transaction?
Like what it's actually worth on the open market.
Precisely. And finally, number 4 is value in use, or sometimes fulfillment value for liabilities. This one's about the future. It's the discounted value of all the cash flows you expect that asset to bring in over its life.
That last one, value in use, feels more specialized, right? Like for things where you can really forecast future cash, maybe complex liabilities or certain intangibles.
Yeah, often it is, though it's a key concept for impairment testing too.
But things like revalued property might shift to fair value, moving away from historical cost.
Correct. And that brings us right to the core tension, doesn't it? The constant push and pull between these different bases.
Let's spend a bit more time on the default setting then. Historical cost accounting, the traditional approach. Assets recorded at original cost, less depreciation for things like machines. Why was this the go-to?
Well, the idea was primarily about stewardship. It aims to show users how well management used the specific resources they were originally entrusted with.
So track the initial investment.
Exactly. Record the purchase price, and then profit is calculated by matching revenue against the original cost of whatever was used up to earn that revenue.
And the upsides are pretty clear, aren't they?
Oh, definitely. It's easy to understand, relatively straightforward to actually produce the accounts.
And objective, that's the big one, right? You have the invoice.
It's reliable, verifiable. You can point to the source document. Less room for, let's say, management bias in the numbers. Auditors tend to like it for that reason.
Okay. Easy, objective, verifiable. Sounds great. But you mentioned grave deficiencies earlier. Where does it fall down?
It falls down hard when prices change significantly, especially when they rise. In periods of inflation, historical cost financials become, frankly, unreliable, misleading even.
How so? What specifically goes wrong for users trying to understand the company?
Well, first, look at the balance sheet, the statement of financial position. Those non-current assets buildings, machinery bought years ago, their carrying amounts are often way below what they're actually worth or what it would cost to replace them.
So the company looks less valuable than it really is in terms of its physical assets.
Correct. And inventory, too. It's valued at what you paid for it maybe months ago, not the current cost to replenish your stock.
Okay, so the balance sheet is potentially understated. What about the profit?
That's where it gets really dangerous operationally. Because your cost of goods sold from that old inventory, depreciation on those old asset costs are artificially low compared to current prices.
Meaning the profit looks bigger than it really is.
Exactly. It's an exaggerated profit in real terms. It doesn't reflect the current cost of doing business. And there's no account taken of how inflation affects monetary items like cash or debt either.
So if a company pays out dividends based on that inflated historical cost profit,
They could be unknowingly paying out their capital. They're distributing funds they actually need just to maintain their operating capacity to replace those assets in inventory at today's higher prices.
wow. So calculating something like return on capital employed becomes almost meaningless because both the profit figure and the asset base are distorted.
Pretty much, it undermines performance assessment.
Can we make this concrete? The example of company A and B buying similar machines.
Right. Perfect illustration.
Uh-uh.
Imagine Company A buys a brand new machine for $50,000.
Yeah.
Company B, maybe a few months later, finds an identical machine, just 1 year older, and buys it for $48,000.
Right.
They run identical operations.
Okay.
Now, even if they use the exact same depreciation method, say straight line over 10 years, at the end of year one, Company A's machine is on the books at $40,000, 50K less $10 KFN. Company B's is at $42,667, 48K less $5,333 for its remaining life.
So wait, B's asset has a higher carrying amount, even though it was older and maybe cheaper initially if you factor age?
Well, cheaper, yes, but its depreciation charge is lower based on its specific cost and remaining life assumption. The point is, their profit statements will show different depreciation charges, leading to different profit figures.
Just because they bought similar assets at slightly different times and prices, following historical cost rules? Not because their operations are different.
Precisely. It kills comparability. Two economically identical businesses look different, purely because the system prioritizes the original receipt over current reality.
That really highlights the problem. No wonder people started looking for alternatives when inflation took off.
Exactly. Historical cost just provides information that's increasingly out of date and potentially understates asset values massively. This led directly to the development of constant purchasing power, or CPP, and current cost accounting, CCA.
Okay, let's tackle CPC first, constant purchasing power. The idea is to adjust for inflation using a general price index.
Yeah, that's the core idea. You take the historical cost accounts and restate them using a broad index, like a National Consumer Price Index or something similar. The goal is to show all the figures in money that has the same purchasing power, usually the purchasing power of money at the year-end date.
How does that work in practice? You mentioned monetary versus non-monetary items.
Right, you have to split everything. Monetary items are things fixed in dollar terms, cash, receivables, payables, loans. If prices rise generally, holding cash means you lose purchasing power. Owning debt means you gain as you repay with cheaper money. CPP accounts calculate and show this gain or loss.
Okay, so it accounts for the inflation effect on cash and debt.
Yes. Then non-monetary items, things like buildings, equipment, inventory, are assumed to broadly hold their value against general inflation. So their historical costs are simply uplifted by the change in the general index.
What's the appeal of CPP then?
Well, it's relatively simple compared to other methods. You just need the historical figures and a readily available national index. It's objective in that sense. And it does measure the impact of general inflation on the shareholders' overall purchasing power.
But it didn't really catch on, did it? What were the criticisms?
The major flaw is that specific prices don't always move in line with general prices. The cost of specialized tech equipment might skyrocket while the general CPI barely moves, or vice versa.
So using a general basket of goods index doesn't reflect the actual cost changes the company is facing for its specific assets.
Exactly. It fails to capture the true economic substance for that particular business. The adjusted figures might not be relevant for actual decision-making about replacing assets or setting prices.
Which leads us neatly to the other alternative, current cost accounting, or CCA. This sounds more targeted.
It is. CCA ditches the general index and focuses on the specific current cost of the company's assets. It's often based on a concept called deprival value.
Deprival value. What's that?
Basically, it asks, if the company was deprived of this asset right now, what would be the loss it suffers? Usually, that loss is measured by the cost of replacing the asset, its current replacement cost.
Okay, so it's directly about replacing that specific asset.
Yes. Under CCA, key assets like inventory and non-current assets are valued at this deprival value, often replacement cost, on the balance sheet.
And how does that affect the profit calculation? That seemed to be the big issue with historical cost.
It changes significantly. CCA introduces additional charges against profit. For cost of goods sold, you don't just charge the historical cost of inventory used. You charge its deprival value at the time of sale.
So the current cost of replacing that inventory.
Correct. And for depreciation, it's calculated based on the current value of the non-current assets, not their old historical cost. This leads to a higher depreciation charge.
So the resulting profit figure should be much closer to what the company can actually afford to distribute without eating into its capital.
That's the main goal. The big advantage of CCA is its relevance. It aims to give users a much clearer picture of the current financial state and the actual cost of operations in today's terms. Helps assess the current performance.
Sounds much better in theory for making decisions, but again, it wasn't widely adopted. What were the hurdles? Why did it fail?
Relevance came at a price. Subjectivity, complexity, and arguably lower reliability compared to historical cost.
How so?
Think about it. You need to find the current replacement cost for all your assets constantly.
Huh.
What if there's no active market? What about unique, older machinery?
Technology changes too, right? The replacement might be a totally different, more advanced machine. How do you value that?
Exactly. Finding suitable market values or indices was a massive practical problem. It involves a lot more estimation and judgment, making it less objective, more complex, and more costly to implement.
And I imagine businesses weren't exactly thrilled about reporting potentially lower profits due to those higher charges.
That was certainly a factor. Lower reported profits could impact share prices, management bonuses, loan covenants. There was significant resistance. The sheer difficulty and cost, combined with resistance, meant it never really took hold despite its theoretical advantages.
Okay, that history is fascinating. The tension between simple objective and relevant complex. Let's try to visualize this. Using that example of a machine bought 4 years ago for $100,000, how would its value look under these different bases today?
Right, let's run through the potential numbers based on the kind of calculations involved. Assume it has a 10-year life straight-line depreciation.
Okay.
1. Historical cost. Simple. $100,000 cost less, 4 years of depreciation, 10th year. $50,000 carrying amount.
Easy enough.
2. Net realizable value, NRV. This is fair value less cost to sell. Let's say you could sell it today for $50,000, but it costs $5,000 to dismantle and ship it. NRV is $45,000.
Okay, lower. What you actually pocket if you sold it.
3. Replacement cost, like in CCA. Maybe a brand new equivalent machine now costs $110,000 due to inflation. It's 4 years old, so you'd apply 4 years depreciation to this current cost. 110K, 10 years, equals 11-year depreciation. So $110,000 less for $11,000 equals $6,000.
Higher than historical cost because the replacement is more expensive.
Correct. 4. Economic value. Value in use. This requires forecasting future cash inflows from using the machine and discounting them back. Let's say using a 10% discount rate, the present value of those future cash flows comes out to $95,755.
Wow, that's way higher than the others.
It can be if the asset is expected to be very profitable.
Look at that range. For the exact same machine, we have potential values from $45,000 all the way up to nearly $96,000.
That's it. It perfectly illustrates how profoundly the choice of measurement base impacts the financial statements. The value reported depends entirely on the accounting rule you pick.
Which brings us back to that fundamental conflict.
It really does. Financial reporting is always trying to strike this balance, isn't it? Between the need for objective, verifiable numbers, which historical cost provides, looking backward, and the need for relevant current information that helps users make decisions about the future, which the current value methods aim for.
So the big takeaway here is that the conceptual framework itself acknowledges there's no single perfect answer. The best measurement base depends on the specific asset or liability and what information you're trying to convey.
Precisely. But what our deep dive really underscores is that when prices are unstable, the flaws in pure historical cost accounting are significant, potentially leading companies and investors to make decisions based on distorted information.
It forces you to question the numbers, especially in inflationary times.
Absolutely. So let me leave you with a final thought to chew on. Imagine a company, maybe an old established manufacturing firm. It's got high levels of debt, lots of machinery bought decades ago under historical cost, and large amounts of inventory.
Okay, typical heavy industry profile.
Now imagine regulators mandated a switch to current value accounting, maybe something like CCA. How would that company react? What would happen to its reported results?
Well, the old assets would suddenly get hit with much higher depreciation based on replacement cost. That would hammer their profits, wouldn't it?
It would likely slash reported profit.
Right.
But think about the other side, that high level of borrowing.
Under inflationary accounting like CPP or even aspects of CCA, having debt is beneficial, right? You pay it back with cheaper money later.
Exactly. They'd likely get a large credit to the profit and loss account reflecting that gain on holding debt during inflation. So you'd have this massive depreciation charge pulling profit down, but potentially a huge monetary gain pushing it up.
What a mess. The net effect could be anything, and it would be incredibly confusing to explain.
Totally confusing, complex, and probably politically charged. It shows how deeply embedded historical cost is, and how disruptive a shift would be, even if theoretically better. Something to ponder next time you look at a balance sheet.